Welcome to the deep dive video update. This is a weekly video where I go through charts that I might have used once or twice in the daily videos, but I'm not using right now. And there's other charts that I didn't use at all. And there's still other charts that are unique just to this video. And we have to look a bit deeper to see if we're getting any clues from these charts. This is being prepared for Monday, April 21st. The first chart is just unique to this video. It's a long-term range of the VIX. And as a general rule, when we're going down, we slip up into a higher range. When we're going up, we're in a lower range. This measures fear. And even though we're increasing over here, we're still below this 20 level when we look at the 50 period moving average of the VIX. Now, market's been under pressure. We're switching to some downtrends across all the major indexes. We could go up into a higher area if things turn more negative. And the VIX still remains elevated. That's where we're getting these higher readings here. But when it stays elevated for longer, then that usually means things are more negative. We're still waiting to see if that's going to happen. Then we also look at the speed of the VIX. How fast is it moving right now? And I use an RSI based on 9 periods to measure that. And we're pretty much neutral now. Even though the VIX really shot up, we were getting very high readings, meaning fear was really high. Well, since that time, we've been coming back down with the VIX, kind of leveling out a little bit. It's still at a very high reading. Anytime we're above 20, that's negative in the bigger picture. But since it's been coming down, we're just about at the midpoint with the RSI now, so I haven't been showing this chart. Then we look at the VIX and then a correlation between the VIX and the S&P 500. Still getting lower readings here, so no real additional insight that way. Then we look at the VIX, and then there's this indicator, if you will, that goes along with the VIX called the volatility of the VIX. It measures how volatile the VIX itself is. And when this is really going up, that means the VIX is actually moving faster than the volatility of the VIX. And in this case, the context is that we're more negative as the VIX has really been going up. Typically, not always, but when this ratio is going down, we tend to be more positive in the market. When this is going up, that means things are more negative. Then a variation of the VIX is called the SKEW Index, which is calculated in a different way using different types of options. And we only pay attention to this chart when we're up in the red area. Well, we finally dropped down. We spent a lot of the early part of 2025 up in the red area as the market was expecting some kind of a big move. Well, since that time, we've been under pressure and the SKEW index has fallen down, so we're not getting any real insight from this chart right now. Then there's a thing called the Landry volatility, and this is calculated just on the S&P itself. So is the VIX and the volatility of the VIX and those measures. But for a long time, throughout 2025, the Landry volatility was pretty even right here. Well, as we've been coming down with the S&P, volatility as measured by this index has really been increasing. Then we look at the volatility of stocks, that's the VIX. We look at the volatility of bonds, that's the MOVE index. And in this context, as the red line's going up, as we're seeing this ratio really going up, that means that stocks are a lot more volatile than bonds. Now, so far in 2025, as of Friday or Thursday's close, the April 17th, bonds based on price are outperforming stocks. Stocks are the weakest performing asset right now in 2025. And we can kind of see that by this red line going up. That means that the volatility of stocks, which usually means they're going down, has been increasing a lot more than the volatility of bonds. Large cap growth. This is a huge part of the overall market. When it's doing well, the market's doing well. Right now, not doing so well. We're dropping further below all of these moving averages, and we're seeing the blue line here, which is a 50 period moving average. It's crossing below the green line, which is a 100 period moving average. So this is turning negative even longer term, and we're seeing the 50 crossing below the 200. That's called a death cross. And we're seeing that in all the major indexes, including the S&P. The Dow just generated one, the NASDAQ 100, the NASDAQ, mid caps, small caps. They're all showing death crosses here, which means we're switching over to a downtrend based on moving averages. Even though we're not officially in bear market territory yet, we have to fall more than 20% for that to happen, and we're not there. But this is just showing that there's real weakness in the market right now, and large cap growth. This is the real backbone of the market going up. Well, this is going down right now. Then we look at a ratio between large caps, which really drive the market up, and small caps. And overall, this ratio has been going up. Even though large caps are under pressure, small caps have been under even more pressure, which tends to move this ratio up. Now, in Thursday's session, we saw this come down. Small caps had a pretty good day compared to large caps. And so we did see a bit of a pullback here, but overall, we look at the general trend, and this is going up, meaning that large caps are outperforming small caps, even though both are not doing all that well. This is a risk on to risk off ratio. We look at high beta stocks, which these are the stocks that everybody wants to own when we're really going up. Apple, Microsoft, Netflix, Google, Nvidia. And that really shows that this ratio is going up when those stocks are outperforming. Unfortunately, when we're going down, they go down faster than the rest of the market. And we see this ratio really coming down when we compare it to the equal weight version of the S&P. And overall, this ratio has been coming down, just confirming that we're under pressure right now. This chart comes in and out of the daily videos. We've been just been chopping around a little bit lately, not really seeing any more recent move, but overall, this ratio has been declining as the market is becoming more risk off. This is another similar measure. We look at high beta stocks, which is what we looked at in the previous chart. But here, this is low beta. These are stocks that tend to hold up better when the market is going down. And overall, this ratio has been declining as well as the market's been negative. Then, just for informational purposes, we go back to the low in October 2022 and October 2023. Well, since that low in 2022, we're still up 51.17%. And from the 2023 low, we're still up 28.73%. So giving back a lot of those gains, but still seeing gains nonetheless. Then I haven't really been showing the advanced decline lines all that much. There's some charts that I show in every daily video, but I dropped these out for a while because we're not really seeing anything all that drastic currently. You look at the cumulative advanced decline line for the S&P based on price, and we've been chopping sideways. Excuse me. Now, some of that could be rotation. At this point, there are times when we're seeing money coming out of the market where people are just selling stocks and going to cash. This overall has been just chopping sideways as it's going from growth areas of the market into value areas of the market. We're seeing a little bit more weakness here with the cumulative advanced decline line based on volume. Now, that could be because the big stocks, Nvidia, Apple, Google, all those stocks, they generate a lot more volume. And if we see selling in those areas, which we've been seeing, that's why we're seeing the volume actually going down with a little bit more intensity. And this is the advanced decline ratio. I do have a chart that I show every day in the daily video that just looks at the upper portion, but it's scaled. The chart is scaled to look different here, where we're just barely positive here based on price, but we're actually below zero based on volume. This chart does include volume, where the chart that I usually show in the daily video, it just is based on price. And here's another cumulative advanced decline line for the NYSE, falling below the moving average, and the moving average is going down. Even though the NYSE is holding up better, it's under pressure too. But it's kind of hanging in there and remaining positive for a bit longer. Then this is one way to calculate an NYSE advanced decline line. We're below the moving average, and the moving average is coming down. You know, we did tick up a little bit in recent sessions. Then on this next chart, this is also an NYSE advanced decline line, but it's calculated in a slightly different way. And I also have the moving average crossover going here. We're still hanging on to things being positive. We did see some recent recovery here, but we're below both of the moving averages. The longer we stay down below here, the more we're probably going to see a death cross with the advanced decline line itself. Then we just look at the common stock, where we have been seeing a little bit more pressure on the NYSE based on price and even more pressure here based on volume. But lately, a little bit of a bounce back up as the markets tried to recover from that big down week that we had week before last and at least show some gains. We ended up being down for the S&P for the week, but there were some recovery attempts. Then we look at technical alerts, and I go through these in the daily videos, and sometimes the list is very long. This list here is really long, but it's not as long as it was a week ago. You couldn't even see it because the list was so long, and you just saw a bunch of colors here. And when you see green, that's positive. When you see red, that's negative. So we can kind of get really quickly, if we see an awful lot of red, the market's usually going down. If we see green here, then we see the market typically going up at that point. Then we look at six different indexes and rank them on a score scale of 0 to 100. The higher the score, the better looking that particular index. And all the indexes are under pressure, but still coming in first place, even though it got hit pretty hard in Thursday's session when United Healthcare came out with their earnings that were not well received and really took that stock down. And since there's only 30 stocks in the Dow, one stock has a good or a bad day, and that can really impact the overall Dow itself. But still, it's not looking very good. But this is the best looking index currently that just generated a death cross itself. And this is the diamonds, which is the ETF for the Dow, and it's coming in at 28.4. This is the best looking index currently based on technical analysis. Then coming in second place is the S&P, not a great score at 27.1, but holding up a bit better because the S&P has growth and it also has value. So when we are going down, it tends to do less worse than some of the other indexes. Then we have the Qs coming in third place at 20.7. Been a lot of pressure on this index and a longer term downtrend as measured by the moving averages coming in at 20.7. And we have the mid caps, which are not doing all that well at 15.4. They've been one of the earlier indexes to actually slip into a downtrend based on the moving averages there. And now the NASDAQ itself is actually coming under a lot of pressure. This is the ETF or the NASDAQ composite coming in at 14. Last place, and here we are in single digits, the IWM, which is the Russell 2000 small cap ETF. And so small caps are just not looking very good. Now, if you go through the intermarket analysis video that I do, the mid caps and the small caps might look attractive if you base things around a PE ratio going forward. They're below 15. They're almost getting down to that inexpensive area. But you might buy that and then wait for a long time because we don't use PE ratios as a timing mechanism. Technical analysis, I like using the two together where that helps us say, okay, what's the overall trend? Because you want to go with what either an index or individual stocks are actually doing. So on one hand, small caps and mid caps might look attractive from a valuation basis, but technically they're just not looking good right now. Short term, this is a rainbow, simple moving averages going from 10 periods up to 50 periods. Clearly, we are in a downtrend in the short term. We're below all the lines. The lines are coming down, and it's just showing how vulnerable the short-term trend is. Then this is the 20 period moving average. Now, what I do is when we're above the 20 period simple and exponential moving average, and simple means all 20 periods are counted the same, they're given the same weight, where exponential, it weights it more towards current prices to try to reflect more reality of what's happening. When we're above that, I consider us as positive as far as the trend. When we're below it, we're negative. We're currently below it. The 20 period moving average did come into play recently because we were coming right up to the 20 period exponential moving average, and we just were not able to break through that. We hit it a couple of times as overhead resistance, and since that time, we've been coming back down. Another rainbow, intermediate term, going from 50 periods up to 100 periods with simple moving averages, also showing how the intermediate term trend is negative and the lines are coming down, prices below all of the lines. Then we look at a 50 period moving average. And I haven't shown these charts in quite a while because we haven't even come near to being back up to these lines yet, and the lines are going down. So intermediate term trend is negative here. And then somewhat intermediate to a little bit long term is the 100 period moving averages, and we're well below those lines. And then this came in and out because we've been really volatile. And this is the point and figure chart, which doesn't take time into account, just price movement. When we're going up and enough, we've gone up enough, uh, green X's are drawn in here. When we're going down and we've gone down enough, red O's are drawn in here. And we're just kind of just bunching together here. It's like we're in a consolidation pattern according to the daily chart, where we're seeing this coming down, this coming up, and we're wondering if this lasts for a while. Are we going to see a breakout to the upside or to the downside as prices have been consolidating? And the Bollinger Bands, and you can use them a lot of different ways. This is just one implementation, the percent B indicator, which measures if we close above or below the upper or lower Bollinger Band. We were extreme negative, but we've been able to work that off as the S&P has been able to stage at least a little bit of a rebound, but we have not even come back up to the midpoint of the Bollinger Band. And that just means that things are remaining more negative. And we're also below the midpoint down here, but we're not getting an extreme reading now, so I haven't been showing this chart. Then this is the Landry light, and this just shows something that we kind of already know, so I haven't been including these charts. When it's red and going down like this, that means we're in a downtrend. And the more we stay in a downtrend, the more this histogram that's red, it continues to add more and more columns here to the reading. This is a very similar thing where the columns are blue, but the background determines if it's positive or negative. We're in a longer term downtrend here with the proper order. Well, since the background is red, that means we're in a negative trend. The CMB composite, I use this like an oscillator. When we go above the black line here or below the black line down below, we're not doing that right now. So I only show this chart when we're getting extreme readings. And this is called the bow tie. And this is also showing some short-term overhead resistance where we have a 10 period simple moving average. And we've been kind of fluttering around that, going above and below it. Then we have a 20 period exponential moving average in red. And that's where we're hitting overhead resistance, which is what we've been seeing on the other charts too, because it's the same moving average. And the fact that we cannot get above this is just suggesting that the short-term trend, it continues to be negative. And we haven't even come close to getting back up to the 30 period moving exponential moving average here. That would mean that there's more of a recovery that's being attempted, and all the lines are going down. So this pretty much confirms that we are in a downtrend. Connor's RSI, very similar to a regular RSI. We look for extreme positive or negative readings, and we're just a little bit above the midpoint. I only show this when we get extreme. And the percent from the closing high, I mentioned earlier that if we go from the all-time high set in February, it's February 19th, 2025, and if we decline on a closing basis 20% or more, we're now in a bear market. Now, we're already in a downtrend based on moving averages, but we're not in a bear market yet because currently we are 14.02% from down below that all-time high that was set. If we continue to fall and we get above 20, that's when we're in a bear market. When we go above a 10% decline, that's when we're in a correction. And that's where we're still at right now. From 10 to 20% is a correction. Below 10%, that's when we're just having a pullback. Then looking at a percentage basis, and earlier on, I haven't had to make any changes to this chart recently because I measure from the intraday all-time high set in February to the intraday low set in April. And on an intraday basis, we did go into bear market territory, 21.4%. We haven't come back and tested that, so this measurement has just stayed the same for the time being. And just measuring how far below are we from the 200 period moving average, the simple moving average, and we're 8.15% below the 200-day moving average. You can see up here, this is what we call a death cross. When the blue line is crossing down below the red line, that's a 50 period moving average crossing below the 200 period moving average. Then I haven't been showing these anchored moving averages because a lot of times they'll act as support or resistance, and we just been kind of slicing through them. So I haven't really seen where we're getting a lot of insight from this. You could say that this is holding up as support. This is going back to the low from October 2023, which is a significant low. So we're still hanging out above this point right now. But then we have other lows. We just slice through it and then just coming back. So the market really isn't, we're not really getting any insight from these moving averages right now. That could change. It's just when we see a lot of volatility, like we have been seeing, these levels don't really act as support or resistance with any conviction. Then this is a 20 period simple moving average of the open, high, low, close. This creates its own little mini rainbow because the colors are changed here. And we tried to come back up into this little mini rainbow, but we hit other areas of resistance. And now we're falling back down below the rainbow, and the rainbow continues to decline. Even though it's based on 20 periods, a lot of times we look at this for shorter term support or resistance. And we keep an eye on the S&P 100, which on a ratio basis is underperforming the rest of the S&P 500. They're usually the ones that lead when we're going up. Well, they're underperforming as we're going down. But we're really just looking for divergences here on this chart. Nothing's really all that apparent right now. And I was using this for a while. When the black line crosses above the red line, that's called a pring bottom fisher, meaning that this is signaling that we've hit a bottom, and that could suggest that we go up. Well, we kind of tried to go up here, but it didn't last. And this signal went away when the black line crossed below the red line, and now it's going down instead of generating another buy signal. So there's been no need to show this chart in the daily videos. Then another long-term rainbow, and we're seeing some weakness. And these moving averages go from 50 periods up to 250 periods, and we're below the rainbow. The lines, the shorter term ones, are coming down, showing that there's a threat to the longer term trend. Then I talk about this in every daily video. It's the special K. It's a long-term oscillator. We're seeing some weakness on the weekly chart, which I don't have here. It's coming down, but it's still above the red line. Well, back in March, we crossed below the red line, and this is showing that on a daily basis, the special K is negative. Then we have a weekly chart of the S&P, a weekly chart of the German DAX, which is the biggest market in the EU. And we look at the correlation between the two, right at neutral right now. Earlier in 2025, the German market was outperforming the US market, but now things are taking on more of a global context. And so everything's been getting hit lately. And so since they've been going down, we were actually seeing a tendency for them to go in opposite directions. That's what happens when it drops below the red line. But now as this correlation is getting stronger again, we're just working our way back up to neutral. Support and resistance, the Ichimoku cloud, we're well below the green cloud. We haven't even come back up to the red cloud yet. So we're far away from it. So there's been no need to show this from a support or resistance standpoint. There are some trend tools here. The green line, this is more short term. Overall, that's been declining, but trying to bounce back up. And then when the blue line is below the red line, that's more intermediate term, and that is also negative. And fib retracements, I stopped using this. I'm using longer term fib retracement charts now. This just measures different areas where we were able to find some support and bounce back up, but we still haven't been able to come back above this 38.2% retracement level. Then looking at the VIXen, which is the volatility measure for the NASDAQ 100, it's also really been going up as the NASDAQ 100 has been going down. This is a weekly chart of the NASDAQ 100 as measured by the QQQs, which is the ETF for the NASDAQ 100. We had a down week, so there's a red candle after having an up week in the previous week. So not a lot of insight, but you can see just an awful lot of red candles here just show that we're in a downtrend. The hope is that maybe we're bottoming and we're going to try to come up out of that, but another red candle just doesn't bode well for that happening, at least right now, but that could always change. Then this is the QQQs using some moving averages. The blue line is the 20-period moving average, and that goes the fastest. That's crossing below the 200-period moving average. But then the longer term trend is the 50-period moving average. That's in red, and that's crossing below the 200. That's called a death cross. And so we're seeing things not looking very good. And we did try to bounce up with the Qs, but the short-term 20-period moving average is also acting as overhead resistance, which is what we're seeing on the S&P 500. Then we look at the S&P on top, and then this is an attempt to do a growth to value ratio between the two, where the Qs, that's growth, and the diamonds, that's supposed to be value, even though there's growth inside of the Dow. And it shows that there's a pretty strong correlation. Everything's been going down lately, the Qs, the Dow, the S&P, and so it's a pretty strong correlated relationship right now. The transports, red line, really underperforming the Dow. The Dow is now in a downtrend, but the transports are doing even worse these days. Then we look at a ratio between staples. These are defensive stocks like toilet paper and toothpaste, and they're outperforming the tech sector. And we're seeing this ratio, which is already established an uptrend, it's continuing to be in an uptrend. When this ratio is going down, you notice how the S&P is going up. When this ratio is going up, that means the S&P is going down. So that just shows the market's getting more defensive. Then we keep an eye on regional banks. Now, there's a bank ETF that I follow that we're now seeing a death cross there, and we've gone into a downtrend. But the regional banks, these are the smaller banks like Silicon Valley Bank, Republic Bank, New York Community Bank. And then we compare them with the financial sector. Now, the financial sector has been getting hit too, but it's holding up fairly well. And we're coming back up to its 200-day moving average. The uptrend is still a little bit more established, even though it's been weakening lately as well. Well, we want to keep an eye on this, and we're seeing this ratio coming down, even though it bounced up on Friday. This means that the smaller banks are underperforming the rest of the financial sector, and that's not positive. We want this to really be going up to be more positive on the market as a whole. Then some long-term rated change charts actually showing a little bit of an improvement here. This is 250 periods, and we came down to this zero line. We were turning more negative longer term, and we're actually coming back up just a little bit. This goes all the way back to 1980, where we fell below the zero line, and now we're coming back above it. So we're seeing a little bit of an improvement longer term, but we're going to have to see a lot more than just this chart going back up. Bonds, and this is where we're looking at the context, and we're looking at the interplay between different kinds of bonds. Short-term bonds, which are 1 to 3 month T-bills, you could almost call that cash. And how are they performing against 3 to 7 year bonds? When this is going up with this ratio, that means there's uncertainty about inflation and interest rates. When this is going down, that means the market's not as concerned about inflation and interest rates. And we're still basically coming down. We saw a bit of a spike up and then more of a decline recently. So this is suggesting shorter term, the market's not really concerned about inflation or interest rates. And we look a little further out and we use tips. These actually adjust for inflation. When tips are outperforming, folks are getting into that because they adjust for interest rates, and that's what you get into when you're worried about inflation. Well, lately we've been seeing this ratio really coming down. So this would suggest that the market is not necessarily concerned about inflation or rising interest rates. And we do that same basic thing, but we look at further out bonds, 7 to 10 year, and these have also been declining. So even though there's inflation worries in the market, we've been seeing it for the most part. It's not coming up in these bond ratios that we look at. So the bond market is not necessarily worried about inflation or interest rates currently. And we look at the long-term bond, which is in blue, and we do a correlation with the S&P, which is in red. The short-term correlation is actually going down because we're seeing bonds going up as stocks have been going down. And we're also seeing a bit of an increase here with the longer-term correlation based on 50 periods. That's actually starting to improve slightly. And we do that same basic thing with the Qs, which is pure growth, and then the long-term bond, which here is in red, still coming up a little bit here with the long-term correlation, but working its way into the neutral area as the market is going through a shift in character. Then we look at the US 10-year yield and subtract the German 10-year yield, and US rates are higher, so we get a result that's above zero. And then we plot this with the US dollar index, and believe it or not, there's a pretty high correlation between the top chart and the middle chart. This is kind of what we're expecting right now. This just means that things are orderly as they relate to interest rates, both in the US and internationally, and then comparing it to the dollar index, which is currency. So it's when we get way down here, that means something really weird is happening. So, as negative as things are right now for the market, the stock market, things are not necessarily acting all that crazy according to this chart. They're acting crazy in other ways, though. And then we look at the 2-year Treasury yield, which overall has been declining, which we're in an environment where shorter term interest rates have been starting to come down as there's some concern about economic weakness. And we look at the 10 to the 2-year yield curve, and this one's fine. It's above zero. That means it's not inverted. It's back to normal, meaning the 10-year yield is higher than the 2-year yield. Because when it drops down and goes inverted, that's when we're concerned that once it goes back to not being inverted, we start to count down to go into a recession. So we're kind of in that countdown mode right now, but this is actually going on for quite a while. Where we're seeing things that are more interesting is the 10 to the 3-month yield curve. We come back down into this red area and go inverted, then we come out, then we go back in. Now we're just right on the border. We're 0.01. That means we're just slightly not inverted currently. And this is another measure that we use to count down to see if we're going to go into a recession. And there's no fixed timeline. It could be 3 months, 6 months, 18 months out. We just want to keep an eye on this because there are concerns that a recession is going to happen. And so there's a lot of different charts that we look at to try to determine is that actually occurring. One of those charts just measures the different yield curves. Then we look at the European stocks, which are now starting to outperform 3 to 7 year bonds. They had really been underperforming as everything was getting hit, but now it's coming slightly back up into the rainbow. And then we look at some different studies here that I call possible positive scenarios. And if we do really click over to more of a bear market, we'll be watching these a lot heavier. These are the percent of stocks in the S&P above their 200-day simple moving average. We use this like an oscillator. When we get extreme negative readings, you can see it happens, or we just get a very low reading. We did get a low reading here, but it wasn't extreme. The other takeaway from this is that we're below this green line, which is 50. If we're above 50, that's more positive. Below 50, that's more negative. We are bouncing back up slightly. We do that same thing with the 50-period moving average study for the S&P. We had come down and we were extreme negative. Well, we're seeing a bit of a bounce up here, but we haven't really seen an awful lot of follow-through strength. And we are also getting extreme negative readings with the mid caps, but still they're not looking all that strong now, but there is some improvement here. And then we're seeing a little bit of an improvement with the small cap index, with those stocks above their 50-period moving averages. So thank you. I hope you found this helpful. I hope you're having a good Easter weekend, and I will talk to you in the next video.